$175 billion. That is how much money is now suspended in legal nowhere, because 6 Supreme Court justices told the president he cannot tax imports under an emergency powers law. On February 20th, the court dropped a 6-3 ruling that invalidated Trump's Liberation Day and other IEPA-based global tariffs, while leaving his Section 301 and Section 232 tariffs intact. Equities surged, importers scrambled, and the institutional money started repositioning before the ink was dry. This was not a procedural footnote. This was the legal scaffolding under American trade policy getting ripped out in a single morning. And in this video, I'm going to show you exactly what broke, what replaced it, and the one countdown timer that will determine whether tariffs come screaming back or disappear for good. There's a 150-day clock ticking right now, and almost nobody is tracking it. We need to talk about that before this is over. New around here? Hit subscribe. I put these out every day so you can actually stay ahead of what's happening to your money, not 2 days behind it. Now, let me split this into 2 lanes because the same ruling means very different things depending on how you are positioned. If you are a long-term investor, someone stacking positions over years, this ruling is quietly enormous. It is a structural reduction in the cost of doing business for every company that sources internationally. Your holdings just got repriced in ways that will take months to fully express. The move is to understand the shift and let it compound. Do not let the political noise make you do something impulsive. If you are a short-term trader, especially if you are using leverage, the next 30 to 60 days are going to be extremely treacherous. The legal and political fallout from this decision is not even close to settled. Every headline between now and the congressional response is a potential whipsaw. Leverage in this kind of environment will eat you alive. I am not being dramatic. I have watched it happen in real time during previous trade escalations. The volatility is the product. You are the raw material. Towards the end of this video, I will show you exactly what the big money is doing right now so you can at least see the board clearly. So here is what the media is getting catastrophically wrong. They are framing this as a clean resolution. Tariffs struck down, markets happy. Next story. That is like calling a building demolition a renovation. Because within hours of the ruling, Trump went to an entirely different legal authority and announced a flat 10% tariff on almost all imports under Section 122 of the Trade Act of 1974. Within a day, he went further, saying he would raise that surcharge to 15%, which is the statutory ceiling under Section 122. Now that law is a relic from the Nixon era. It was written to deal with short-term balance of payments problems, basically temporary measures to stabilize currency flows. It was never designed to be a permanent trade weapon. But here is the constraint that matters. Section 122 caps tariffs at 15%, and they expire automatically after 150 days unless Congress votes to make them permanent. So the executive branch went from claiming unlimited emergency tariff authority to operating under a law with a ceiling and an expiration date. That is a significant reduction in firepower, but it is still a tariff. It still hits supply chains, and for certain countries, the math is brutal. Let me walk you through the numbers because they tell a very specific story. China is now facing one of the heaviest combined tariff burdens in the world. The new global surcharge under Section 122 stacks on top of the existing 25%. Section 301 tariff that the court did not touch. The 25% comes from Section 301 investigations into intellectual property theft, a completely different legal track. So Chinese manufacturers just got the worst of both worlds. For U.S. allies like the EU, Japan, South Korea, India, and Vietnam, the shift from the old IEPA schedule to a flat Section 122 surcharge generally means their headline tariff rates drift down from the mid-teens or higher into the low teens, depending on the product and on what is still in place under Sections 301 and 232. Every one of those drops changes the competitive equation for thousands of businesses making sourcing decisions right now. A 5 to 8 point reduction in tariff costs can be the difference between a factory staying overseas or relocating. And steel and aluminum tariffs did not move at all. Those are under Section 232, which is a national security authority the court did not even look at. So if you are in metals, construction materials, or automotive supply chains, your cost structure did not change 1 cent. The auto sector is still carrying roughly 25% on imported vehicles and parts. Electronics and tech hardware remain heavily exposed because so much of the component supply chain runs through East Asia. Now here is a wrinkle most people miss completely. Lower tariffs on some goods do not automatically help every American company. Domestic producers who do not import much, the ones who benefited from foreign competitors being taxed at higher rates, actually lose their pricing advantage when tariffs drop. Their foreign rivals can now undercut them. Meanwhile, the companies that were supposed to benefit from reshoring incentives, The industrial automation firms, the logistics operators, the domestic construction equipment makers, they lose some of their tailwind because the urgency to move manufacturing stateside just got weaker. The tariff reduction cuts both ways depending on where you sit in the supply chain. And do you know who loves this particular flavor of chaos more than anyone? The banks. More policy uncertainty means more volatility. More volatility means more trading volume. More trading volume means more commissions and wider spreads. When Goldman Sachs writes materially more trade uncertainty, that is not a warning. That is a revenue forecast. Now here is where I need to separate what the crowd believes from what is actually happening. Most people think the Supreme Court just lowered trade taxes. In reality, the court demolished the legal theory that allowed the president to impose tariffs without Congress. That is a fundamentally different thing. The tool they killed was the International Emergency Economic Powers Act. It was signed into law in 1977 by Jimmy Carter. It was designed for one purpose: sanctions, freezing foreign assets during genuine national security crises, blocking financial flows to hostile nations. It was never written to tax consumer goods at the Port of Long Beach. But starting in 2025, the administration stretched that statute to cover broad-based import tariffs, arguing that trade deficits constituted a national emergency. The court rejected that argument entirely, and they did not stop there. They invoked something called the major questions doctrine. This is a legal principle that has been gaining power over the last few years, and it says that when a government action has sweeping economic consequences, Congress has to explicitly authorize it. You cannot take a vague or loosely worded old statute and use it to justify something it was clearly never meant to cover. The Wharton budget model estimates that roughly $175 billion in tariffs were collected under this now invalidated authority. That is not a rounding error. That is real money taken from real companies. And the court said nothing about refunds. Justice Kavanaugh, in his dissent, warned that the refund process would be a disaster. Translation: there are going to be years of litigation. Companies like Costco are already lining up to file claims. If you own shares in major importers or retailers who paid these tariffs, there is a potential windfall sitting in the legal pipeline. But do not expect fast resolution. This is going to grind through the courts for a very long time. The lawyers are the only guaranteed winners here. And here is a detail that reveals the political temperature. Two of Trump's own Supreme Court appointees, Gorsuch and Barrett, voted with the majority. That is not a partisan ambush. That is a constitutional line being drawn by judges the president himself put on the bench. Trump responded by calling the decision deeply disappointing and said he was ashamed of certain members of the court. He accused justices of being swayed by foreign interests and called them a disgrace. That language matters. It tells you how much executive power this ruling clawed back. Now, let me connect the dots on the two completely different realities operating in the market right now. Reality A is the surface. The tariff burden dropped. The effective tariff rate in the United States fell from 16.9% to 9.1%. That is still the highest since 1946, nearly 80 years ago. But it is a significant reduction from a rate that had not been seen since 1935, which is the year the aftershocks of Smoot-Hawley were still rattling global trade. Markets rallied on the news. Growth stocks popped. Tech names like Apple, Nvidia, and Alphabet surged because lower tariffs feed into lower input costs, lower inflation expectations, and potentially faster rate cuts. That is the story the screen is telling you. Reality B is what is happening behind the screen. The White House did not concede. It pivoted within hours. A new tariff went up immediately under different legal cover. And Trump made a statement that should make every investor pay close attention. He said the methods, practices, statutes, and authorities recognized by the court are even stronger than the ones they just struck down. He also said that foreign countries who are dancing in the streets will not be dancing for long. That is not the language of retreat. That is the language of escalation. Both of these realities, the relief rally and the escalation threat, cannot coexist forever. One of them is lying. And the resolution of that contradiction is going to drive markets for months. Here is where the macro math gets really interesting. Budget analysts and Wall Street economists both agree that higher tariffs show up as modestly higher inflation, and vice versa. The combination of the court's ruling and the new Section 122 structure probably shaves a few tenths of a percentage point off inflation compared with the IEEPA peak, and even more if Congress lets the Section 122 surcharge expire. In a monetary environment where the Federal Reserve has been sweating over every tenth of a percent in the core PCE number, that is a meaningful shift. It could be the difference between one rate cut this year and two or three. Now, there's a feedback loop here that most analysts completely ignore. Higher tariffs raise import prices. Higher import prices push inflation up. Inflation keeps interest rates elevated. Higher rates strengthen the dollar. A strong dollar makes American exports more expensive overseas. Expensive exports widen the trade deficit. And a wider deficit creates political demand for more tariffs. It is a doom loop that feeds itself. This ruling just cracked that cycle open. Less tariff pressure means less inflation, which gives the Fed space to ease, which weakens the dollar, which helps exporters, which narrows the deficit, which reduces the political case for tariffs in the first place. That is why the market reacted the way it did. It was not just pricing in lower costs. It was pricing in the possibility that the entire monetary and trade trajectory just bent in a different direction. And the appointment of a new Fed chair, widely expected to be more willing to cut aggressively, only amplifies that shift. The real story is not the court ruling. The real story is the 150-day countdown. Section 122 tariffs die automatically unless Congress acts. That puts the expiration somewhere around mid-July of 2026. Between now and that date, every tariff headline is a referendum on whether the legislative branch has the stomach to make these taxes permanent. And this is where trade policy crashes directly into the 2026 midterm elections. If Republicans hold both chambers and pass tariff legislation before the clock runs out, these import taxes become embedded in the code. History says they will never leave. The Smoot-Hawley Tariff Act passed in 1930, and its remnants persisted in various forms for decades, long after the economic rationale had evaporated. Tariffs are the cockroaches of fiscal policy. But if the midterms shift the balance even slightly, if Democrats pick up enough seats to block or filibuster, the Section 122 tariffs simply expire, and there is no automatic mechanism to reinstate them. The structural force at work here is not any individual politician. It is the incentive architecture of Wall Street itself. Banks profit from the uncertainty. Every tariff twist generates volatility. Every policy reversal generates trading volume. Goldman Sachs published a note saying the environment now features slightly fewer tariffs, but materially more trade uncertainty. Read that slowly. The institutions are not losing sleep over this chaos. They are monetizing it. More confusion means wider spreads, more hedging demand, more commission revenue from clients who have to reposition. Your exposure to risk is literally their source of income. That is not villainy. That is just the plumbing of the system working exactly as designed. Now let me give you two scenarios so you can think through your positioning, no matter which way this breaks. The bearish path first. If Congress rallies behind the White House and formalizes permanent tariffs before the 150-day window closes, we are looking at a prolonged period of elevated trade friction. Inflation stays sticky at or above 3%. The Fed holds rates higher for longer. The dollar stays firm. Export-heavy companies get squeezed on margins. Import-dependent businesses either absorb the cost or pass it through to consumers. If you're a long-term investor in that world, you want companies with domestic supply chains, industrial automation, construction, logistics firms that help businesses reshore manufacturing. If you are a short-term trader, every single congressional vote on tariff legislation becomes a volatility event. Leverage in that environment is a meat grinder that does not care about your thesis. Now, the bullish path. If political fractures, if enough Republicans in competitive districts decide tariffs are hurting their voters, if the midterms create gridlock, then the Section 122 tariffs simply expire in July. We enter a window of genuine trade normalization. Inflation drops faster than consensus expects. The Fed cuts 2 or maybe 3 times in the back half of the year. Growth stocks and big tech rip, the dollar softens. Emerging markets catch a bid as capital flows out of the safe haven trade. For long-term investors, that is where you want exposure to international supply chains, high-growth names, and rate-sensitive sectors like housing and tech. For short-term traders, the relief rally could be sharp and fast, but do not confuse a snapback with a trend change. Even in the bullish case, the path is going to be noisy. Now here is what the smart money is actually doing while everyone else argues about politics. The institutional flows tell a clearer story than any pundit on cable news. Large funds have been trimming exposure to import-dependent retailers because the refund timeline is uncertain, and the new tariffs still create margin pressure. They have been rotating into domestic industrials, companies that benefit regardless of which tariff scenario plays out. And they have been cautiously adding to big tech, the names like Apple, Nvidia, and Alphabet that surged after the ruling because their global supply chains just got cheaper to operate. The pattern is not complicated. Follow the capital, not the commentary. Track sector ETF flows. Watch the options market for unusual volume. And pay attention to the 13F filings when they drop, because that is where the real positioning shows up. The simplest thing you can do right now is review your own portfolio sector by sector. Know exactly how much of your exposure is tied to import costs, export competitiveness, and interest rate sensitivity. Set a stop loss on every position, not because you expect disaster, but because in an environment where a single tweet or congressional vote can move markets 2 or 3% in an afternoon, protecting your downside is the only edge a retail investor actually has. So where does this leave us? 3 key takeaways and we are done. Number 1, the Supreme Court did not just cancel some tariffs. It set a constitutional precedent through this major questions doctrine that limits every future president's ability to impose trade taxes without Congress. The rules of the game changed permanently on February 20th. If you invest in America, that date matters. Number 2, the 150-day clock under Section 122 is the single most important variable in the market right now. Every portfolio decision between now and mid-July should account for 2 possibilities. Tariffs become permanent law, or tariffs vanish entirely. If you do not have a plan for both outcomes, you do not have a plan. Number 3, the institutions are not confused by any of this. They are profiting from it. Banks, hedge funds, and large asset managers have the infrastructure to trade every headline faster than you can read it. Your advantage is not speed, it is discipline. Set your stop losses. Know your sector exposure. Do not marry a position when the policy ground is shifting underneath you every single week. Here is the unresolved question I want to leave you with. We are watching a live stress test of the separation of powers. The judiciary drew a line. The executive immediately tried to walk around it. Congress now holds the deciding vote, and the midterms will determine whether Congress exercises that authority or hands it right back. Does the constitutional check hold, or does the next workaround render it meaningless? That question is going to shape markets for the rest of 2026 and possibly beyond. None of what I have said here is financial advice. I do not know your risk tolerance. I do not know your time frame. What I do know is that the people who come through these moments intact are the ones who understand the mechanics, refuse to react emotionally to headlines engineered to provoke emotion, and manage their downside before they ever think about the upside. Tell me in the comments, do you think Congress locks in permanent tariffs or lets them die on the vine? I want to know what you are seeing from where you sit. Stay sharp.